Today.
Thank you. Good morning,
I want to get your views. Good morning. We've been waiting for this Fed liftoff for quite some time. Let's just assume the Fed goes forward tomorrow. What should investors be on high alert for here? Is it simply the fears over the high yield that we've seen really coming to a fore the last few days? Do you think those are accurate? Is this the real deal, or could they be perceived as overblown to some extent?
No, I think a lot of expectation have been built in. I think what the Fed hinted at, I mean, the potential for capital market dislocation ahead of or after a Fed hike is what we've seen in the high yield bond market. We have seen in emerging market currencies, we have seen in emerging market bonds and also equities. And I suppose after the Fed, we potentially could see a relief rally and the dollar could taper off a little bit. But I think for investors, the bigger question is, why have they waited so long? Because you see, Mr. Bernanke, he called his memoirs the courage to act. Our question really was, why did they wait so long to get this out of the way? Because the 25 basis points increase should actually not be such a big deal. And I suppose once they hike the 25 basis point increase is in the market, I think we potentially could see a relief rally in risk assets. However, having said that, I think it might be short-lived.
So a bit of a short-lived relief rally, but we've already seen some volatility, as I just touched on, especially coming from junk bond fears. Does this have the potential to really trickle out more into the equities market?
Potentially, yes. I mean, that is the bigger question, whether, I mean, at least equity market returns for 2016 could be more subdued and potentially could even turn negative. I mean, this year is already negative. I suppose next year will be very volatile and also will be challenging, because I think it's really about, it's not just in equity, it's also in fixed income. It's about credit quality. It's about underlying fundamental strength of the companies, because global growth is still unfortunately disappointing to the downside, and there's also a lot of geopolitical risk. So I think it's conscientious security selection in 2016 more than just the broad market. I think the broad market gains in the US are very difficult to get next year, so it will be much more about a long-short strategy.
Okay, bearing that position in mind, where should investors go? Is this time to deleverage, let's say?
Most probably, yes, because I think, I mean, this is what we've seen in the currency market as well. Once these very crowded trades unwind, like the high yield market is, in my opinion, is still a very crowded trade. It's usually going to be very painful. And I think now is a good opportunity to sort of look at your overall exposure and then maybe scale that back, because you've got very crowded trades and the backdrop against falling GDP growth in many countries around the world. Still, it's actually very, very negative for future prices going forward.
And you've also commented that we could be seeing the end of what you call the last great bubble, being this dependence on central banks. But when you look here in Europe, for instance, the ECB has continued to show a willingness to be supportive with additional stimulus. Does that suggest that you prefer Europe over US, or what is your position globally then?
Look, I mean, our view is that Europe and Japan are preferred markets over the United States because of this policy divergence. But I suppose the more interesting market could be Japan, especially in dollar terms, because I think the yen potentially could also have bottomed out. And I think this is why potentially we could see more euro weakness and also a little bit of a rebound in European equities, because I think Mr. Draghi made it very clear again just the other day that they are still in favor of stimulus. But I suppose the bigger question is, at what level and when does the faith in global central banks come to an end? And I think this is also what the gold price is telling us. The gold price is not really moving. It's somehow stuck around there, the $1,000 an ounce level, because maybe gold is very cheap, like gold mining stocks. And again, it's an area that is very unloved and under-owned, and many areas of the market are potentially too crowded. So I think we could see some repositioning going into next year, and some of those unwinding could be quite volatile.
Okay, so gold, one of your favorite picks there. Well, thank you for joining us. That's Michael Preiss of Taurus Wealth Advisors. And still to come here on Capital Connection, a boardroom battle heating up. Francis Vivendi and Telecom Italia are at odds ahead of its